January 24th, 2026. Gold touches $5,000. Silver breaches $100. Bitcoin collapses below 90,000. The dollar fractures at 99. You're watching the monetary system tear itself apart in real time. This is not a rally. This is not a bubble. This is not speculation. This is the moment when 70 years of financial engineering reaches its terminal velocity. The moment when paper promises collide with physical reality. The moment when the world discovers that the price on your screen and the metal in your hand are no longer the same thing. Gold has risen 80% in 12 months. Silver has exploded 237%. These are not numbers. These are screams. These are the market telling you that something foundational has broken. When an asset that has existed for 5,000 years suddenly moves like a penny stock, you're not witnessing a trend. You are witnessing a regime change. The banks did not expect this. They built a system where 100 ounces of paper silver could be sold for every single ounce of physical metal in existence. They assumed that no one would ever ask for delivery. They assumed that confidence was infinite. They assumed that 356 paper claims on the same bar of silver was a sustainable business model. They were wrong. And now the entire architecture of modern commodity pricing is coming apart. Now we need to talk about what makes this moment different from every market move you have ever seen. The signal that is breaking every rule of traditional finance. The signal that reveals this is not about profit anymore. This is about survival. In a normal world, when stocks rise, bonds fall. When inflation rises, currencies strengthen to contain it. When uncertainty rises, liquidity contracts. These are the rules. These are the correlations that every computer, every algorithm, every risk model on Wall Street was built to understand. But look at what is happening right now. Gold is making all-time highs. Silver is making all-time highs. Stocks are near all-time highs. This should not be possible. This is not strength. This is terror. When safe haven assets and risk assets rise together, you're not seeing economic optimism. You are seeing a collective realization that there's no safe place left to hide except out of the currency itself. The market is not rotating. The market is fleeing. Everything is rising because the denominator is dying. The dollar is not a measuring stick anymore. It is the thing being measured. And it is being found worthless. This is the signature of monetary collapse. In Weimar Germany in 1923, stocks rose. Real estate rose. Commodities exploded. People thought they were getting rich. They were not getting rich. The currency was evaporating. In Zimbabwe in 2008, the stock market went vertical. In Venezuela, in 2018, everything priced in bolivars went parabolic. This is not wealth creation. This is wealth preservation in real time. And it is happening right now in the world's reserve currency. Global debt has reached $346 trillion. That is not a number you can understand because there is no reference point in human history. Total global GDP is at 110 trillion. The debt is 3 times larger than the entire annual economic output of every country on Earth combined. The United States alone owes $31 trillion. Japan owes 256% of its GDP. The entire structure of government finance in the developed world is held together by the assumption that this debt will never be paid. It will be refinanced forever, at low rates forever. But what happens when rates cannot stay low anymore? What happens when the very act of printing more money to service the debt makes the debt grow faster than the economy? What happens when central banks try to unwind their balance sheets and discover that there are no private buyers left at these prices? The answer is sitting in front of you right now. Gold at $5,000, silver at $100. The market has already made its decision. It no longer believes. The Federal Reserve is under investigation. The chairman faces criminal probes. The institution that was designed to be above politics, above pressure, above doubt, is being exposed as just another bureaucracy. And the market is reacting the way markets always react when the central bank loses credibility. It runs, not into another currency, not into another bond. It runs into the only assets that do not require trust: gold, silver, physical metal that does not depend on a signature or a promise or a computer entry. Metal that has been money for 5,000 years because it is the only form of money that cannot be printed. This brings us to the most dangerous signal in the entire market right now: the fracture between paper and physical, the moment when the price on a screen and the price of actual delivery become 2 completely different numbers, the moment when the illusion ends. Right now, if you want to buy silver on the COMEX Futures Exchange in New York, the price is quoted around $100 per ounce. But if you want to take physical delivery in Shanghai, you will pay $130. In Tokyo, premiums have reached 60% above spot. In Dubai, 40%. This is not a regional price difference. This is not a temporary dislocation. This is the market bifurcating into 2 separate realities. One where silver exists on paper, and one where silver exists in the real world. COMEX registered inventories have collapsed 70% since 2020. In early January, 33 million ounces of silver were withdrawn for physical delivery in a single week. That is 26% of the entire registered inventory vanishing in 7 days. The London vaults have lost 40% of their holdings. Shanghai inventories are at decade lows. And China, which refines 65% of the world's silver, just implemented export controls that require government licenses to ship metal overseas. Only 44 firms have been approved. The rest of the world is being cut off. Do you understand what this means? This means that the futures exchanges, the paper markets, the entire price discovery mechanism that the financial system has relied on for 50 years no longer controls the price of silver. Physical supply controls the price now, and there is no physical supply. The COMEX is facing delivery requests it cannot fulfill. Lease rates have spiked to 8%. Lease rates are the cost of borrowing physical metal to cover short positions. When lease rates go from near 0 to 8%, it means the metal is not available at any reasonable price. It means the shorts are trapped. It means the system is breaking. This is not just about silver. This is about the entire architecture of commodity finance. If the paper market for silver collapses, if the COMEX declares force majeure and admits it cannot deliver, then every other commodity market becomes suspect. Copper, platinum, oil, gold. The moment one exchange admits that its contracts are not backed by physical inventory, every contract on every exchange becomes a question mark. And when that happens, the real price is whatever someone with actual inventory wants to charge. There is no bid, there's no offer, there's only negotiation with the people who hold the real asset. This is where the system breaks. Because the banks, the hedge funds, the institutional players, they do not hold physical metal. They hold claims, they hold contracts, they hold promises. And those promises are about to be tested in a way they have never been tested before. Now we need to understand what is causing this, not the surface story. Not the news about tariffs or geopolitical tension, the real cause, the systemic cause, the reason this was always going to happen. For 15 years, since the financial crisis of 2008, central banks have been buying government debt with newly created money. This is called quantitative easing. The Federal Reserve bought $9 trillion of bonds. The European Central Bank bought trillions more. The Bank of Japan bought so much debt that it now owns more than half of all Japanese government bonds in existence. This was sold as stimulus, as emergency policy, as temporary. It was none of those things. It was debt monetization. It was the government printing money to buy its own debt because no one else would buy it at those prices. And now they are trying to reverse it. They call it quantitative tightening. They are selling those bonds back to the market. But who is buying? Not foreign governments. China and Japan have been selling U.S. treasuries, not buying them. Not pension funds. They are underwater on the bonds they already own. Not insurance companies. They cannot afford more duration risk. The answer is no one. No one is buying. So yields are rising. And when yields rise, the value of existing debt falls. And when the value of debt falls, the banks and institutions holding that debt take losses. And when they take losses, they need to sell something to raise cash. And the only thing they can sell that still has a bid is physical assets. This is the feedback loop. Debt crisis leads to currency debasement, leads to inflation, leads to rate hikes, leads to debt crisis. There is no exit. There is no soft landing. There is only the choice of which type of collapse you prefer, hyperinflation or deflationary spiral. And right now, the market is betting on inflation. Because every time the system gets close to breaking, the central banks print more money, they have to. The alternative is letting the entire structure collapse. So the money supply expands, and the currency loses value. And the only assets that maintain purchasing power are the ones that cannot be printed. Gold, silver, real estate, commodities, anything with physical scarcity. Anything that exists outside the financial system. This is not just a Western problem. China is drowning in debt. Total debt in China is over 300% of GDP. The property sector, which accounts for 30% of the economy, is in freefall. Developers are defaulting. Banks are hiding losses. Local governments cannot pay their bills. And the central government is printing money to keep the system alive, just like the United States, just like Europe, just like Japan. The entire world is trapped in the same system. Too much debt, too little growth. Central banks printing money to buy time. And every time they print, the currency becomes less valuable. And every time the currency becomes less valuable, the price of hard assets rises. This is not a prediction. This is mathematics. This is what happens when you create more claims on resources than resources that exist. And the resource that is breaking first is silver. Because silver is unique. It is the only asset that is simultaneously an industrial metal, a monetary metal, and a strategic metal. Industry needs silver for solar panels, for electric vehicles, for semiconductors, for 5G networks, for artificial intelligence hardware. Investment demand needs silver as a store of value that is cheaper than gold, but just as scarce. And now, governments need silver for military applications, for advanced manufacturing, for technology supply chains. 3 different buyers, all fighting for the same finite pile of metal. And none of them can be priced out because they all need it for critical applications. Global silver production peaked in 2016 at 900 million ounces. It has been falling ever since. Current production is around 820 million ounces. But industrial demand alone is 600 million ounces. Add investment demand, add jewelry, add government stockpiling, and you get total demand of over 1 billion ounces per year. That is a deficit of 200 million ounces every single year for 5 consecutive years now. Where does that missing 200 million ounces come from? From above ground inventories, from exchange warehouses, from bank vaults, from recycling. But those inventories are not infinite. They are being drained. And when they run out, the only way the market can balance is through price. Silver has to rise high enough that some buyers drop out, high enough that substitution becomes viable, high enough that new mines become profitable. But how high is that? $150? $200? $300? No one knows because the market has never been this tight before. This is not like 2011 when silver hit $49 on speculation. This is a structural shortage. This is geology and geopolitics and industrial demand all converging at the same moment. And the price is being suppressed by the paper market until the moment it cannot be suppressed anymore. And that moment is arriving. This is the global confirmation, the signal that cannot be ignored, the evidence that what is happening in New York is happening everywhere. In Shanghai, physical silver trades at a premium to COMEX futures. That premium is currently over 30%. This tells you that buyers in Asia do not trust the paper price. They are paying extra to ensure they get real metal, not a contract, not a claim, not a promise, the actual ounce, because they understand that in a shortage, the paper promise is worthless. Only the physical metal has value. The same pattern is visible in India, which is the world's largest importer of physical silver. Premiums are spiking. Wait times for delivery are extending. Dealers are rationing supply. This is not normal market behavior. This is what happens when supply chains are breaking, when the flow of metal from refiners to consumers is being interrupted, when geopolitical decisions override market forces. China controls 65% of global silver refining capacity. And on January 1st, 2026, China implemented export controls. Firms now need government approval to ship silver abroad. Only 44 companies have been granted licenses. The message is clear. China is hoarding silver. Not for investment, not for speculation, for strategic purposes. Because silver is now classified as a critical mineral, a national security asset, something too important to allow market pricing to determine its allocation. This is the same playbook China used with rare earth elements: restrict exports, build domestic stockpiles, use control of physical supply to gain geopolitical leverage, and it worked with rare earths. The West scrambled to find alternative suppliers. New mines took years to develop. And during that time, China set the global price. Now China is doing it with silver. And the West has no answer because there is no alternative supplier of this scale. Mexico produces silver, but not enough to replace China's refining capacity. Peru produces silver, but ships it to China for refining. The entire supply chain runs through China, and China just closed the door. What does this mean for price? It means that Western markets are now structurally short. COMEX cannot get metal from Asia. London cannot get metal from Asia. The refineries that used to supply New York and London are now supplying Shanghai and Mumbai. The physical flow has reversed. And when physical flow reverses, price has to adjust. But paper markets do not adjust instantly. They adjust when forced. And the forcing mechanism is delivery requests. When longs stand for delivery and the exchange cannot deliver, that is when the paper price becomes irrelevant. That is when physical price takes over, and we are watching it happen. Open interest on the COMEX. January 2026 silver contract surged, not because people want to trade silver, because people want to own silver. They are using futures contracts as a delivery vehicle. They are bypassing the retail market. They are going straight to the exchange and demanding metal. And the exchange is struggling to fulfill those demands because the metal is not there. It is in China. It is in India. It is in private vaults. It is anywhere but in COMEX warehouses. Lease rates are now the smoking gun. When lease rates spike above 5%, above 8%, it means bullion banks are desperate to borrow metal to cover short positions. It means they sold futures contracts backed by metal they did not have. And now they have to find that metal or default. And they cannot find it because the metal does not exist in size anymore. It has been consumed by industry. It has been bought by investors. It has been locked away by governments. The fractional reserve system that allowed 100 paper ounces to be sold against 1 physical ounce has reached its limit. And when fractional reserve collapses, price does not adjust gradually. It gaps, it jumps, it goes vertical. Because there is no price at which supply meets demand when supply does not exist. This is the defining characteristic of the silver squeeze. It is not a squeeze on price. It is a squeeze on supply. And squeezes on supply do not resolve through arbitrage or hedging or financial engineering. They resolve through real-world production, through new mines, through recycling, through substitution. And all of those things take time, years. The market does not have years. The market has weeks, maybe months, before someone is forced to declare force majeure. Now we need to address the lagging asset, the contradiction, the thing that should be rising but is not, the thing that reveals what the market really believes about the future. Bitcoin is at $89,000. It was at $126,000 3 months ago. It has fallen 28%, while silver has risen 237%. This is not an accident. This is a choice. The market is choosing physical over digital, tangible over intangible, history over innovation. And that tells you everything about the psychological state of investors right now. Bitcoin was supposed to be digital gold. It was supposed to be the alternative to fiat currency, the hedge against money printing, the escape route from central bank debasement. And for a while, it worked. Bitcoin rose when governments printed money. It rose when confidence in institutions fell. It rose on the same narrative that drives gold. But now it is falling. And the reason it is falling is because the market is realizing that in a true crisis, in a true collapse, in a true breakdown of financial infrastructure, you cannot eat a blockchain. You cannot hold a private key. You cannot melt down a hard drive and turn it into something useful. Bitcoin requires electricity. It requires internet. It requires functioning exchanges. It requires a financial system that can custody and transfer and settle digital assets. When that system is under stress, when banks are failing, when counterparty risk is spiking, when trust is collapsing, Bitcoin becomes a liability, not an asset. Because Bitcoin is not a physical thing. It is a digital claim. And digital claims are only worth what the system backing them is worth. This is the harsh truth that the market is discovering right now. When you need to move value across borders, Bitcoin works. When you need to avoid capital controls, Bitcoin works. When you need to speculate on the future of digital finance, Bitcoin works. But when you need to preserve purchasing power through a monetary collapse, when you need to own something that will still have value after the system resets, Bitcoin is a question mark. Gold is not. Silver is not. They have been money for 5,000 years. They will be money after this crisis ends. Bitcoin might be. Or it might be the first asset to go to zero when the exchanges freeze and the miners shut down and the regulatory hammer falls. The market is making a bet. And the bet is that physical wins, that scarcity wins, that history wins. Bitcoin fell from 126,000 to 89,000 because $600 million in liquidations hit the market, because leveraged longs got stopped out, because the momentum broke. But silver rose from $40 to $100 because the metal is not available, because industrial users are panic buying, because governments are stockpiling, because the paper market is being drained and there is nothing left to sell. This is the difference between a speculative asset and a real asset. A speculative asset falls when sentiment turns. A real asset rises when supply disappears. Bitcoin is sentiment. Silver is supply. And right now, supply is winning. The dollar is the other lagging asset. The dollar index is at 99. It should be collapsing. It should be in free fall. The Federal Reserve is under investigation. The government is running trillion-dollar deficits. Debt is exploding. Confidence is eroding. Every traditional indicator says the dollar should be weak. But it is not weak. It is holding. Why? Because every other currency is worse. The euro is backed by negative growth economies and a central bank that is still buying bonds. The yen is backed by a central bank that owns half the bond market and is trapped at zero rates forever. The yuan is controlled by a government that prints money to cover up a property collapse. There is no alternative. There is no safe currency. There is only the least ugly currency, and that is still the dollar, but this is a temporary condition. The dollar is not strong because America is strong. The dollar is strong because there is no other option. And the moment there is another option, the moment gold becomes the global settlement asset, the moment central banks stop holding dollars and start holding metal, the dollar will not decline gradually. It will break. It will lose 20% of its value in months, because the only thing holding the dollar up is the lack of an alternative. And that alternative is being built right now in China, in Russia, in the Middle East, in every country that is buying gold and signing bilateral trade deals and moving away from dollar invoicing. The dollar's strength is an illusion. It is the last moment of calm before the system resets. And the market knows this. That is why gold is at $5,000, even though the dollar is at 99. That is why silver is at $100, even though the dollar is not collapsing. Because the market is forward-looking. It is pricing in what comes next, not what is happening now. This is the final contradiction. The dollar holds, but gold explodes. The dollar holds, but silver explodes. These two things cannot be true at the same time, unless the market believes that the dollar's value is artificial, that it is being held up by intervention, by central bank currency swaps, by the lack of alternatives. Then the moment those supports are removed, the dollar collapses and everything priced in dollars goes vertical. This is the regime change. This is the turning point. This is the moment that will be studied 50 years from now as the beginning of the end of the dollar standard. Here's the final verdict, the conclusion that cannot be avoided, the reality that every investor, every institution, every government is being forced to confront whether they want to or not. The monetary system is no longer functioning. It is surviving. There is a difference. A functioning system processes transactions efficiently. It maintains confidence. It balances supply and demand through price signals. A surviving system lurches from crisis to crisis. It depends on intervention. It requires constant liquidity injections. It cannot allow market clearing because market clearing would reveal insolvency. We are in a surviving system now, and surviving systems do not last. They either reform or they collapse. Reform requires political will. It requires admitting mistakes. It requires taking short-term pain for long-term stability. And there is no political will. There is only the will to extend, to delay, to pretend. So collapse is the only option. Not a sudden collapse, not a single-day event, but a rolling collapse, a slow-motion unraveling, a loss of confidence that spreads from one market to another until there's nothing left to believe in except physical assets. Gold at $5,000 is not a peak. It is a milestone. Analysts are forecasting $6,000. Some are forecasting $8,000. Some are forecasting levels that sound insane until you realize that gold is not rising, the currency is falling. If the dollar loses 50% of its purchasing power, gold does not need to rise to $10,000. It just needs to stay the same while the dollar halves. The number changes. The value does not. Silver at $100 is not the top either. Silver can go to $150, to $200, to $300. Not because of speculation, but because of supply destruction. Because mines cannot produce enough. Because recycling cannot keep up. Because industrial demand is inelastic and investment demand is accelerating and government demand is opaque. When all three types of demand converge on a single commodity in structural deficit, price is the only adjustment mechanism, and that adjustment can be violent. Bitcoin at 89,000 is a warning. It is the market telling you that digital is not a substitute for physical when the system is breaking. It is telling you that technology is not a hedge against collapse when technology itself requires the system to function. Bitcoin will survive this crisis, but it will not thrive during it. It will thrive after, when the new system is built, when stability returns, when confidence is restored. But not now, not during the transition, not during the chaos. The dollar at 99 is the most dangerous number on the board. Because it looks stable. It looks like strength. But it is a trap. It is the moment before the cliff. It is the last chance to exit before the door closes. When the dollar breaks, when it loses its status as the global reserve currency, when central banks dump treasury bonds and rotate into gold, the adjustment will be faster than most people can react. Because currency crises do not give warning. They happen overnight. Literally overnight. You go to sleep and the exchange rate is stable. You wake up and it has moved 20%. That is how currency crises work, and that is what is coming. What does holding cash mean in this environment? It means you are making a bet that the system holds together, a bet that inflation stays contained, a bet that central banks regain control, a bet that the dollar remains the reserve currency, a bet that confidence does not collapse. How confident are you in that bet? Look at gold. Look at silver. Look at the market's behavior. The market is not confident. The market is hedging. The market is running. Cash is not a neutral position. Cash is a short position on hard assets. Cash is a bet that everything will be fine. And if you are wrong, if the system breaks, if the currency collapses, then your cash buys less, a lot less. And by the time you realize you were wrong, the price of protection will have already moved. You will be chasing. You will be buying gold at $7,000, buying silver at $150, buying assets at nosebleed valuations, because the alternative is holding currency that is losing purchasing power by the day. Time is the enemy now, not just because prices are rising, but because settlement is slow. When you decide to buy physical metal, there's a delay. Days, sometimes weeks. For large orders, longer. And during that delay, price can move a lot. If you order silver at $100 and it takes 2 weeks to settle, you might take delivery at $120 or $130 because the market is thin, because supply is constrained, because the bid-ask spread is widening. This is what happens in a physical squeeze. The price you see is not the price you pay. The price you pay is the price at settlement, and that price is unknowable until the metal is in your hand. This is why waiting is dangerous. This is why hesitation is costly, not because you need to panic, but because the window is closing. The window where metal is still available at spot price. The window where dealers have inventory. The window where settlement is measured in days, not months. That window is narrowing. And once it closes, once the system shifts from paper price discovery to physical price discovery, the game changes completely. You are witnessing the final squeeze. Not a squeeze on shorts, not a squeeze on speculators, a squeeze on reality, a squeeze on the physical world, a squeeze on the assumption that paper claims can substitute for real assets. That assumption is breaking. It is breaking right now, in real time, on your screen. The banks did not expect this. They thought the fractional reserve model could last forever. They thought confidence was infinite. They thought that as long as they could settle in cash, they would never have to settle in metal. They were wrong. And now the system they built is eating itself. Paper is devouring paper. Contracts are consuming contracts. And the only thing left standing will be the physical metal in the vault. This is not a prediction. This is not analysis. This is observation. This is watching the system break and reporting what is visible. Gold at 5,000, silver at 100, Bitcoin falling, dollar holding, physical premiums spiking, inventories draining, lease rates exploding, governments hoarding, exchanges struggling. This is not normal. This is not a cycle. This is a phase transition from one type of system to another, from paper to physical, from trust to verification, from belief to proof. The question is not whether this continues. The question is how fast, how violent, how far. Because the direction is set, the momentum is undeniable. The system is moving from paper to physical, whether anyone wants it to or not. Because the alternative of pretending that 100 paper ounces can be backed by 1 physical ounce, that alternative is no longer viable. The market has called that bluff, and the house cannot cover the bet. What comes next is not a crash. It is a repricing of what money is, a repricing of what value means, a repricing of what it costs to own something real in a world of infinite digital claims. And that repricing has already begun. You are watching it, right now, in the price of gold, in the price of silver, in the collapse of Bitcoin, in the illusion of dollar strength, in the premiums in Shanghai and Tokyo and Dubai, in the empty vaults in London and New York. This is the moment. This is the threshold. This is the point where doing nothing is itself a decision to stay in cash, a decision to trust the system, a decision to bet that this time is different, but this time is not different. This time is exactly the same as every other time in history when debt exceeded the capacity to repay it, when currencies were printed to cover deficits, when trust in institutions eroded, when the old system died and a new one was born. The final squeeze has begun, not on a single asset, on the entire financial architecture of the modern world. And when this squeeze resolves, when the paper finally burns and only the physical remains, the people who understood what was happening, who moved before the window closed, who chose reality over illusion, they will be the ones who preserve wealth through the transition. The rest will be left holding claims on a system that no longer exists. The banks did not expect this, but the market always knew. The market always knows. And the market is screaming the answer right now, in gold, in silver, in the widening gap between paper and physical, in the inventory drains, in the export controls, in the desperation of industrial buyers, in the silence of central banks who have no solution left except to print more. This is not the beginning. This is not the middle. This is the final act. And you are watching it unfold in real time.